What is market inefficiency in trading? In this video, you will learn what is market inefficiency, why it occurs, and how to treat it. I will show you a lot of real market examples and share very useful insights. Please don't forget to like this video, subscribe to my YouTube channel, and let's start. In order to understand the concept of market inefficiency, first let's discuss what is the market efficiency. The price of an asset is constantly striving to find a fair value. A fair value is the price of the asset that provides the equilibrium between supply and demand on the market. A fair value reflects the perception of the market participants based on all the news and data that are available about the asset. Simply put, that is the price that all the market participants agree about. On a price chart, the fair value of the asset usually represents the price range. By the range, I mean a horizontal parallel channel that forms after the sequence of impulsive bullish and bearish movements, after the imbalance in supply and demand, and some moment the market finds the equilibrium. And the formation of the range is the perfect indicator of such equilibrium. It indicates that the market stabilized and it can remain within that range for a very long period of time, signifying the balance in supply and demand. Look at the real market example on euro dollar. After quite a strong bearish movement, the market stopped falling. The market started to trade within a horizontal range. It signifies that the market finally found the equilibrium. The market found the fair value. And the range signifies that the market became stable and the market participants agree about current prices. According to the theory, the efficient market reflects all the information about the asset in its price. Hence, in the efficient market, the price equals or almost equals the fair value. Please note that 100% efficient market does not exist. It is the economic fairy tale, but the nature of the financial markets constantly aims to maximize its efficiency levels. But why the markets cannot be fully efficient? The surprising fundamental data, the news, the rumors make the market constantly reassess its fair value. That creates the imbalance in supply and demand, and it makes the price shift rapidly. Such price adjustments are called the market inefficiency. Common characteristics of the market inefficiencies are the high momentum candles and the price gaps. In technical analysis, the violation of one of the boundaries of the fair value range usually confirms the inefficiencies and provides a very strong trading signal. Take a look at the price action on gold. You can see that the market was growing steadily and then gold started to trade within a horizontal range. And you can see that here the market found a fair value. But then a surprisingly positive release of US CPI report made the market very bullish. Such a candle here is a perfect example of the inefficiency because the market participants rapidly started to reassess the fair value of gold. And now the market is looking for a new fair value price. Please also note that human factor can also cause the market inefficiency. The examples of such inefficiencies can be the emotional decisions and wrong assessment of the market fair value. After consolidating for almost a month within a horizontal range, euro dollar bounced rapidly after the release of surprisingly positive fundamental news. The breakout of the resistance of the range was the example of the inefficiency, and after that the market started to grow rapidly and look for a new fair value. As the market participants assess the new data, the price strives to find a new fair value. Strongly negative news pushed the prices lower till the equilibrium in supply and demand is established and a new fair value is found. Take a look at the price action on CAD Swiss pair on a daily time frame. The market found a fair value and for a very long period of time the price was stuck within a range. Then the release of the negative news turned the pair bearish and the price violated the lower boundary of the range, its support. That was the example of the inefficiency, and then the market started to fall rapidly and look for a new fair value. Then, much lower, the market started to consolidate and started to trade within the range, meaning that the market finally found a new fair value. Alternatively, very positive news make the price go higher till buyers and sellers find the consensus and the new fair value, making the price stop growing. Now let's analyze the price action on a euro CAD pair. The pair found a fair value on a daily time frame, and the market remained very stable for a long period of time and traded within a horizontal range. Then the release of very bullish news created the imbalance in supply and demand. The range, the upper boundary of the range was broken, and that was the example of the inefficiency. The market was growing rapidly till supply and demand found an equilibrium and a new fair value was found, and the market started to trade within the range again. Usually the point where the market stops is a significant liquidity zone, support or resistance area. Returning back to our example on CAT Swiss, the market stopped falling after it reached a significant liquidity zone, a historical support. After its test, the market finally found the equilibrium and a fair value. Quite often, the market participants overestimate the impact of the news. The false evaluation of the market data make the price quickly return back to its fair value. Look what happened with US dollar index after the release of important US fundamentals. You can see that the market was stuck within the range. The market definitely found the fair value, and after the release of the news, the market bounced rapidly. The range was broken, and here we got the inefficiency. However, quite quickly the market participants realized that they overestimated the impact of the news, and then rapidly the price returned back within the fair value range. Your job as a trader is to learn to recognize these inefficiencies because it provides profitable trading opportunities. Price action patterns, technical indicators, candlesticks indicate potential inefficiencies. It indicates potentially oversold or overbought, undervalued or overvalued market. And smart money concepts is simply the strategy, the technique to recognize and treat these inefficiencies. Once you spot the market inefficiency that is caused by the news or by any other factor, quickly assess its real impact. Assess the significance of that event and analyze whether the market correctly reacted to the news or the market overestimated its impact. The attack of Israel by Hamas made gold prices go up rapidly, violating the fair value range. This event changed the geopolitical sentiment in the world, causing the reassessment of a fair value of gold. The price went hundreds of dollars higher before it found a new fair value. Inefficiency is one of the core terms in smart money concepts trading. The understanding and the ability to recognize that properly is essential for profitable trading that strategy. Let me know, traders, in the comment section if you have any questions. Also, traders, if you want to learn how to trade, do not forget to check my premium group, the link in the description below. Also, traders, do not forget to watch my other videos.